You got what tickles for me. I got lots of pictures in my head. You better not turn off the projector. I got lots of pictures in my head. You better not save them all for later. And maybe oh, get me on fire. Could take your picture. Oh, you could get one too. And maybe oh, get me on fire. But keep me on, don't switch me off. 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 You better not turn off the projector. Keep me on. Keep me on, don't switch me off. Keep me on, don't switch me off. Keep me on, don't switch me off.
Let's get close, closer than close, closer than you ever can imagine us. Let's get close, closer, yeah, closer than you ever can imagine us. All week long, I've been waiting. Every night I sit to hear a whole thing on. Dreams of you keeps me alive. This time, no, I'm never gonna let you go. Let's get close, closer than close, closer than you ever can imagine us. Let's get close, closer, yeah, closer than you ever can imagine us. Ooh, open my mystery. You're the one who has the key. Bring that magical paradise. I never felt that you inspire uncontrollable desire. Let's get close, closer than close.
Well, thank you very much for your time this morning. Can everyone hear? Okay. I can't see the back row, so I don't know if your hands are up or not. Just a statement before we start. Anita James is kindly presenting the financials today, following Noel having a slight accident on Saturday, where he was pursuing his leisure activity of choice, and the front wheel of his bike got caught in the tram tracks. So he broke 7 ribs and he's got a collapsed lung. His doctors told him he can't fly. I said to him when he rang on Saturday that maybe he could have hitched a ride on one of our explosive trucks and whatever up to Sydney for the presentation yesterday, but he declined that opportunity. So Anita's kindly agreed to step in to the breach. So at the end of the presentation, if there are any particularly difficult questions, just refer them to Anita. Okay. Everyone read it? Okay. So I'll go over the overall performance, then Anita will cover financials and balance sheet. And then I'll come back on our projects, and then structure and strategy, and then give you some general feedback from the market and what the reaction's been to the full year result and the overall messaging that's coming out of that. The blue bars are our all worker recordables, or total recordable injury frequency rate. The green bars are our lost time injury frequency rate, and the red line indicates our severity index. So basically a compilation of the overall severity of the accidents we had during those periods. The numbers within the blue bars are the number of fatalities in the year. So in spite of the fact of our severity index improving and our lost time injury frequency rate continuing to improve, we had a fatality. So one of our employees, Juan Carlos, in the shock tube plant in Antofagasta, Chile, suffered fatal injuries following an explosion in his part of the plant. And again, it's a reinforcement point that we need to be putting even more effort into the identification of hazards, in the engineering controls we can put in place once those hazards have been identified. There's a toolbox package that's out through the Globe and other medium for everyone in the company to go through a presentation of what happened in this fatality and what are some of the learnings out of it. I encourage everyone to present to others and be involved in groups that go through that package, because there are some quite significant learnings coming out of that fatality. On general community/environment, where those two meet, on greenhouse gases, we've actually undertaken some technical pursuits in abatement, which will give us the equivalent of taking around 150,000 cars off the road. So we are contributing to the overall thrust of abatement of greenhouse gases across the world. And as Burrup comes on, then we'll put the same things into Burrup and up the amount of abatement that we're experiencing and sharing with people. The other major thing we're pursuing is mineral carbonation. That's an alternative way to capture CO2 as opposed to carbon sequestration. Basically, under pressure and high temperature, you blow CO2 offtake from power stations through a kiln type arrangement over serpentinite, which is a clay type material, and that mimics a natural phenomenon where the CO2 is locked up on the clay particles and it's stable. So if we can crack this, it's an actual better sustainable way to capture CO2. And when we prove it works, it can be retrofitted onto existing power stations. Carbon sequestration you can't, or you can, but it costs too much. So this is an alternative pathway. It's run out of the Newcastle University and we'll be working with them over the next 4 years. But it shows our commitment for those long-term points of where the community meets the environment. So our group financial performance, our statutory profit was 402.8 million as opposed to last year's 642 after we wrote down Minova. So if you look at the underlying profit before the impairment of Minova, we made 650 million, so a 1% increase on what we did last year in some pretty trying times. So basically we've taken Minova down to around 1.1 billion carrying value, and the goodwill on that is just over 700 million. So we're putting Minova in a spot where for the profile of earnings we should get from Minova over the upcoming years, it truly reflects and has a relationship with what the carrying value is. There's been some conjecture in the market for a fair while that that carrying value and the earnings we were getting from Minova didn't have the greatest of direct relationships. Now I'd suggest that most people think it has a more direct relationship. On our dividends and earnings per share on underlying went up. And our dividends per share, 92 cents for the year after a final dividend of 54 cents, which was franked at 45%. So we gave a franking percentage which was a little higher than what people expected, and we continued that progressive dividend policy going forward. So we have been lifting dividends 1 cent each half year, and we continue to do this on these results. So that's basically an encapsulation of the highlights. The other point, right down at the bottom in very small print, it says that this year, 2013, we expect to earn more than we did in 2012. So some challenging times, but the profile we're presenting at the moment suggests that we should be able to beat last year's earnings. So on that note, I'll hand over to Anita.
Oh, that is bright. Thanks, Ian, and good morning, everyone. Excellent. Firstly, just a few words on the Minova asset impairment. As Ian mentioned, we took a charge of $247 million in the 2012 results, and the makeup of that charge is detailed here. The charge principally relates to goodwill carried in North America and China, and to a lesser extent, to the extent that China supports goodwill carried at the Minova Group level, that has also been impaired. The impairment charges reflect the challenging market conditions that both North America and China have faced during the period, particularly in the second half, and which are expected to continue in the near term. For those not working in Minova, just to give you a little context, in North America, demand from coal markets dropped considerably in the second half, with year-on-year volumes down 7%. Continued competitive pressure in a weaker market has meant we have not seen margins recover to historical averages. In China, we have seen continued competitive pressure and margins have been constrained. Whilst conditions for Minova are expected to remain difficult in the near term, we do expect to see some recovery in market demand in the medium term, and in addition, we are undertaking a significant project within Minova which should see returns improve. Ian will touch on what we're doing in Minova a little later on. Despite some of the headlines in the newspapers, if anybody's picked up the newspapers today or yesterday, the Minova impairment, whilst a big number, was probably anticipated by the market, given that the conditions in Minova have been difficult for a couple of years, and certainly those working in Minova would well know that. From a group EBIT level, group EBIT was down 1% or $5 million on the prior year, a strong underlying result given the headwinds of foreign exchange and the impact of Kooragang Island. Despite challenging conditions in some markets, we saw improvement in both price and volume. Prices were modestly improved in our mining services business, particularly in North America, and product mix was favourable. We also saw stronger pricing in our mining chemicals business. Partly offsetting these upsides were lower margins in parts of Minova. Volumes were up in most of our mining businesses. In mining services, Australia, Asia and Latin America performed well. In Minova, Australia and the CIS were up, and in chemicals, sales of emulsifiers were strong. Sales into North America, in North American coal markets, were understandably weak for both mining services and Minova. Surplus land sales and the non-recurrence of the Monclova plant closure in Latin America positively impacted EBIT by $31 million. On the downside, plant closures at Kooragang Island impacted EBIT by $69 million, with costs of $90 million in the first half of 2012, offset by $21 million that we had in August and September last year. The strong Australian dollar again adversely impacted our translated earnings, while higher depreciation, amortisation and inflationary factors contributed an increase in our fixed cost base of $40 million, and the trending higher ammonia costs resulted in an unfavourable lag of $25 million. So a strong underlying result, marred by obviously Kooragang Island and foreign exchange. In our mining services business, earnings were down 3% to $790 million. Demand was generally strong, with AN volumes up 2%, driven mostly by improved volumes in mining markets in Australia, Asia and Latin America, offset by weak demand in US coal markets. We again saw strong growth in electronic blasting systems, with volumes up 14% on the prior year. Prices were modestly improved. The combined effect was an improvement in earnings of $134 million. Surplus land sales and the non-recurrence of the Monclova plant closure added a further $28 million to EBIT. But as you can see from the waterfall chart, these improvements were more than offset by the Kooragang Island shutdown, higher fixed costs, the lag in recovery of some input costs, and the unfavourable impact of foreign exchange. As a result, EBIT margins for the mining services group decreased from 20.7% to 18%. And for any of those that have caught up on the newspaper articles this morning, it was probably this result that disappointed the market somewhat yesterday. Obviously the volume improvements in some markets was a positive, but obviously the issues that we've had at Kooragang Island in manufacturing, weaker demand and pricing conditions in Indonesia obviously meant that the result for mining services wasn't quite as strong as some expected. Moving on to Minova. Minova delivered EBIT up 4% to $109 million. In terms of volumes, we saw reasonably strong demand in Australia and the CIS, which more than offset the impact of weak demand in US coal markets and subdued activity in many parts of Europe. The benefit of volume improvements combined with productivity and efficiency programs more than offset the impact of continued margin pressure in North America, Poland and China, mostly arising from competitor activity. EBIT margins as a result were in line with the prior year at 12.8%. Chemicals had a good year with EBIT up 8% to $211 million. Mining chemicals delivered another strong result. The sodium cyanide market remains very firm and emulsifier sales were up. Water care was down marginally on the prior period. The benefit of higher global caustic prices was offset by lower volumes, partly impacted by wet and mild summer conditions, particularly in New South Wales. In general chemicals, overall volumes were down on the prior period, whilst trading volumes into mining markets were up and Latin America showed good growth in industrial and construction sectors. Demand from most industrial markets in Australia and New Zealand was weak. Margins were also down, negatively impacted by strong local currencies. Overall EBIT margins for the chemicals group increased to 13.3% from 13% in the prior period, a good result. Now moving on to cash flow. Net operating cash flow was positive at $544 million, but down $214 million on the prior period. Key factors driving the movement included the cash flow impact of Kooragang Island, higher interest and higher trade working capital levels. We'll touch on working capital in a moment. Again, for those that have caught up on newspaper articles, certainly cash flow, when talking to investors and analysts yesterday, was a disappointing result in what we issued yesterday. I think investors are particularly looking for same cash flow impact from the significant capital programs that we've had over the last few years. Also, our working capital levels increased in 2012 over 2011, despite the fact that demand conditions have softened somewhat, and certainly the outlook going forward is for reasonably steady demand. So to increase working capital in those sorts of conditions, really from an investor base is not terribly acceptable. So whilst the rolling trade working capital to rolling sales trend looks positive, it did increase marginally on last year. The rolling percentage that we look at was 13.3% and up slightly on 13.2% last year. The period end trade working capital though, which is what most people look at, increased by $121 million versus the prior period. Whilst this reflects an increase in stock levels, largely attributed to what we might consider one-off or explainable events, as I said, it wasn't something that people generally accepted terribly well yesterday. So the commissioning of Bontang increased contingency stock levels following the Kooragang Island incident, growth in the Pilbara supply chain and a stock build in North America ahead of a supplier plant shutdown in October all contributed to higher stock levels. Looking at CapEx, in 2012 we spent $234 million on CapEx, slightly higher than we have on average over the last 5 years, partly impacted by some spend on environmental programs at Yarwun and Kooragang Island, as well as the turnaround of our AN plant at Kooragang Island. We spent $395 million on growth capital. This included spend on Bontang, Kooragang Island and the Hons project in China, as well as a number of other smaller projects. And in addition, we made an initial cash contribution of $41 million to the Burrup joint venture. Ian will provide a little more detail on where we're at with many of these large projects later in the presentation. I won't go through every number on this slide, but if you are interested in the intricacies of interest cover and interest expense, etc., I'm sure Ross McKean or Judith Mamora in corporate would be more than happy to have a chat to you. But there are a couple of numbers here that are of particular interest to the market, particularly cash conversion. So that cash conversion percentage of 72% versus 81%. As I said, that's a reflection of the fact that we're not throwing off as much cash from our operating activities as certainly we did last year as a percentage. And again, as I said, that's a disappointing factor from the market. The gearing level at 41.5%, we have a preferred gearing range between 35 and 45%. So that gearing having increased year on year, again, is a factor that the market's just starting to look at. Still an acceptable range, but something that, particularly if we continue to spend from a capital point of view and don't increase generation of operating cash flow, that will put further pressure on that number. This slide simply shows that the maturity profile of our drawn debt. Again, if you're very interested in that, have a chat to Ross McKean in Treasury and Corporate. But the general takeout from this slide is that we maintain a generally flat maturity profile and low refinancing risk. I won't go into the intricacies of this slide, only to say that at a group level we do hedge a lot of our foreign currency exposures, both from a transactional and a translational level. We generally take out hedging at the start of the year, and which gives us some confidence, I guess, in delivery of budgets, etc., throughout the year. We've taken hedging for about 30% of our exposures at the start of the year, and we'll review that as time goes on. In terms of environmental provisions, on our balance sheet we carry around $203 million for environmental provisions. Much of that relates to remediation activities that we're undertaking at our Botany site, with the 3 big projects there being obviously the groundwater remediation, HCB remediation and the mercury remediation. Needless to say, work is progressing well on those projects. HCB, the encapsulated waste, we have 2 HCB issues at Botany. One was encapsulated waste in a car park at Botany. The other is the stored HCB waste, which certainly got some media headlines a couple of years ago when we were looking at exporting that. The encapsulated HCB waste has mostly been dealt with. We're now remediating the area, doing final groundwork on the remediated area. In terms of the HCB stored waste in drums, we're still looking at what we do with that. In the meantime, we continue to safely store it at Botany. That's Ian. I'll now hand back to Ian.
Thank you very much, Anita. I'll just go back and make a point on this. We tend to share with the market a lot of information and a fair few negatives. If you look at the other side of what this represents is, Orica has got a fantastic land bank. We've got lots and lots of land, a lot of which when we remediate, we can sell off. So it's not just the negative side of what we need to carry as a provision. Over time, we need to make sure that we have a focus whereby we continue to sell down that land bank and subsidise or give us a return on those provisions. Okay, I'm going to go through our projects. I'm going to talk to Bontang. I'll just make the point that Kurri Kurri and Port Hedland are now in place. And Port Hedland is an emulsion plant as part of our move into northwest Australia, servicing the general Pilbara area. I'll go through Honts, Sustain, Optimova, Burrup, Kooragang Island. I'll jump the three studies. It's enough to say that future cyanide capacity and South American AN plant are progressing well as studies. Yarwun probably won't be progressing at the same rate it used to. We'll probably put that on the slow burner. Can't see us doing northeast for a long while. Okay, Bontang. Basically, we produced 60,000 in the 3 months that it was up and running. That's an average of 20. If you annualise that, it's 240. As you know, over the 3 months, these things ramp up. So we're getting towards its installed capacity at just over 300. But to get it to the full 300 mark, we have to make sure that the way we use the wharf, the way we interrelate with other people using the wharf, does not hold the whole plant up. One other thing is that we've been granted, I don't think we've got the final paperwork yet, but we've been granted an export licence. So Bontang, and I'll come back to this point later, will feed into what we've set up or are setting up as an agglomeration or archipelago of AN production points. On Honts, the project will finally be finished early next year. Hooray. It should come in at our Australian dollar original estimate or thereabouts. It's a troubled project. It's been on the go for a fair while. And it's a good indicator that we really need to change our approach to the way we go about some of our projects. It's a good challenge for Ron Douglas, who's coming in to look after projects. Project Sustain. This is about us getting to the point where we're the exemplar in industry and the innovator with industry when it comes to safety, health, environment, community and risk. So we'll be adopting semi-quantitative risk assessment throughout the organisation, using that as a monitor point for all the engineering controls we need to be pursuing, and making sure that's fully portrayed and communicated throughout the organisation. We really need to put our foot down on how we go about our community relations. I think we've started to move in that direction, but KI was a reinforcement point that you have to deal with regulators and communities in an open and ongoing manner if we're going to continue to have our licences to operate. Further on Project Sustain, all the agreed regulatory projects at Yarwun and KI are on plan or are finished. So at Yarwun we finished the projects that we said we'd do in November. So by the end of this month they'll be commissioned and we'll actually be able to capture most of the storm events that occur at Yarwun. There'll still be the occasional storm event because it's in the semi-tropics where you can't put in the installed capacity to capture that, but we won't be having our licence breaches as we have in the past. At KI, we'll continue on with those licence to operate regulatory agreed projects, with the biggest of which the ammonia upgrade. This is to the plant itself and the way we control the plant, largely completed by the end of 2013. So we're going to continue to spend about $100 million on what I consider to be licensed to operate improvements at KI to get the plant to a state that it should have been in years ago. Minova to Optimova. This is a good business for where it plays. It's a great entry point for a bundling of services. So we have to get it closer to mining services and really play a lot harder in the underground mining sector. Now that whole sector constitutes less than 15% of our EBIT at the moment. It's a growth point that we need to pursue. The other thing about Minova is once we go through Optimova project, it has a really good cash conversion. So historically it's about 96%. We can probably push that up a bit over time. But it needs to be configured in a way that it can be integrated into the overall Orica workings. So we need to simplify the business model. We need to optimise the manufacturing points, because at the moment we have too many of them. And we need to rationalise the overheads. So what you'll see out of Project Optimova over the next 2 years, because it has a 2-year time frame, is that Australasia, Asia and Africa will be integrated into mainly mining services and a little bit into manufacturing in the course of 2013. And then Europe will be integrated again as a sub-project within Optimova in 2013-2014. And then the Americas will be fully integrated by the end of 2014. What we're going to be doing in Europe is putting a project in place to integrate mining services with Minova. So over the course of the upcoming 12 months or so, we're going to run an aligned approach for mining services in Minova that should give us a better presence in Europe without a lot of the duplication that we currently have. And that'll push down on its costs. So we've done a fair bit of study on Optimova and what it means in the longer term. So we expect that over the period 2012 through to 2017, it should start to approach the RONA, or return on net assets, that Orica talks about as one of its target points. Now these are numbers before we take into account the integration synergistic savings as well. So we should be able to get it to 18%. In spite of that overall profile, in the upcoming year, or the year we're now in, 2013, the earnings of Minova will drop. So we're going to go after market share, we're going to preserve our market share, and some of the costs that we'll be introducing because of Optimova project will push the EBIT contribution from Minova down by about 20% in this financial year. And then it'll grow over time. Just a couple of points about the coal price and gas price in the US, and that's really been one of the drivers for us to take the carrying value to the point we have, because of what we've seen in the market over the last 6 months and what we envisage we'll see over the next 12 to 18 months. So people are talking about the end of the world when it comes to gas price and no more coal and da-da-da-da-da. It's a typical media conversation, not based on the best of data. So if you look at that table at the bottom of this, in April of this year, the gas price tanked. So the average over April of this year in the US was $2.14. And it got down to about $1.82 on April 20. So since that time, the gas price has come back by about 92%. That's off a very low base. And if you look at what the gas price was on October 31 this year, it was $3.50. 12 months ago it was $3.66, and 12 months before that it was $3.42. So there's lots of ups and downs during the year. But basically what you're seeing in gas price now is what you've seen over the last couple of years. And the coal, as a percentage of the energy curve in the US, has responded accordingly. They tend to have efficient energy markets, unlike Australia, so price translates through to action, whereas in Australia governments get in the way all the time. So you'll see that kick up on the red line, which is the coal percentage of US energy. So it bottomed out at 32.4%, and it's back now about 38 to 39. So most pundits expect gas in the US to be in the $4 to $5 range, and the percentage that coal contributes to the energy curve being around the 40 to 45%. So of course one of the drivers of how much coal is produced will be how quickly the US economy comes back, but most pundits again are expecting that this slow uptick in the US economy will continue over time. So basically what that means is coal in the US in 2013 in thermal will be at least equal to what you saw in 2012 over the whole year. But a lot of the APS mines, or the Appalachian mines, have dropped out of the market. Now that's not a market that we play in much. So other people are more exposed to that drop than we are in the long term. So we think coal's coming back in the US. The other thing that the US is allowing itself to do is rebuild its industrial base on the back of these lower gas prices, which are about half what you see in Australia and about a quarter of what people are wanting the gas price to move to in Australia and Asia. Now, if you get that differential for too long, the US is going to come back really strongly as an industrial base. So people talk about China surpassing the US by 2030 economy size. Don't think so. The US is rebuilding itself very quickly. It's one thing they're very good at doing. And our positioning there needs to be reflective of that. Kooragang Island. We've finished the fees, so that work is basically at a point where you can say you're at end of feasibility study. We've got an engineering pathway for construction, and that's been confirmed with the board. Most of the long lead items have been ordered. So we're going to go back and we're going to have discussions with customers. So basically we won't be starting construction to at least the end of 2013 or the middle of 2014. So the market is such that it doesn't need an expansion of Kooragang Island at the moment, but it will at some stage. I'm talking about the market out of the Hunter Valley. So we'll be going ahead with this when it is right and proper to meet the market, but we won't get ahead of the market. So we're going to go back and talk to our customers about their long-term commitment, what they see as their projects going forward, and then we'll make a determination on the basis of that as to when we go ahead with construction. It was really nice of Incitec Pivot to give us a time frame for this when they said they wouldn't pursue their project for at least another 2 years. So we can afford to take our time having those discussions with customers. But this is a business point that we all need to appreciate. You never get in front of a market, you just waste money. And we would have wasted a lot of capital if we'd committed to this at the start of this year. If you think our share price tanked yesterday, it would have tanked doubly so if we'd announced yesterday that we're going ahead with this expansion at this particular point in time. Burrup. Main points here are that we are opening up what is for us a new market. We haven't played to any great extent in the northwest of Western Australia, and up until quite recently the percentage of EBIT that comes from iron ore has been 3%. So on the back of what we're doing at Burrup and building up the emulsion plant and the storage points, etc., we should lift that to around 7 or 8% of our EBIT. So that does two things. It opens up a new market, but two, it gives us a diversification point away from thermal coal. At the moment, if you look at coal for us, it's about 33% of our EBIT. That's too narrow. We have to broaden that base. So the site prep for Burrup being built has started. And I'd just like to go over the particulars of the arrangement that we went into with Burrup. So we paid $110 million as an entry fee. We get 100% of the marketing rights to everything that's produced from Burrup. and we contribute 45% of the capital cost. So we control the market. People can't go out and underprice us to place their percentages. We get 100% of that offtake. And then 94% of the revenue we get from sales of initiating systems and services associated with that ammonium nitrate in the Pilbara, we get to keep that revenue. And then the 6% goes back in to the Burrup JV, and we get 45% of the profit back out of the JV. So we effectively get around 95–96% of all the revenue out of any initiating system sales and services, and then we get 45% of the profit out of the sales of ammonium nitrate and 6% of the revenue from the others. So it's a pretty good deal. The market doesn't fully appreciate it. Some of the slower analysts are still having trouble putting it into their model, but we'll hold their hands and get them there. This is a different approach, and it's an approach we'll probably want to take to other parts of the world, because again, you're not overcommitting your capital, but you're keeping control of your market, and it's a growth way without spending too much before you get that market giving you money back. That's a really important message. Last point on these projects is security of supply. What you see on that map constitutes over 50% of our mining related EBIT. And what we're basically building after Burrup is an archipelago, as I said before, of AN plants where you can mix and match throughout this area. So if you combine those 4 AN production points with various emulsion plants and the other storage points that we've built, as in 40,000 tonnes of storage in the Pilbara we've just finished off. We've gone for an export licence in Bontang. We've gone for an import licence in WA. So we can mix and match and back each of these plants up, given any hiccups. Touch wood, we won't have any, but just in case, you always plan for contingencies. But we don't have to expand any individual plant until we see the whole of this region needing expansion. And we can also use places such as Burrup to back up growth in Mozambique, in coal, etc. So it gives us that footprint that is unequalled by others. It gives us the ability to say to our customers that we can afford to give you security of supply. That is a very big differentiating point for us as a company. So let's move on to structure and strategy. This is our business model. So everything I say about structure, everything I say about strategy, everything I say about how we're going to position ourselves for the future goes through the lens of what this business model tells you. So we have to base ourselves on social integrity. If we don't get that right, we won't have a licence to operate. And then it moves through to the sunlit uplands of our customers. So the structure is to reinforce that whole point. Some of the projects we're pursuing are to enable us to deliver this business model. We presented to the board a refreshment of the strategy last week, and I'll just go through some of the highlight points. It's a refreshment of the strategy, i.e. we're not going to say that we're going to sell everything and move into production of toys or ships or whatever. We're going to stick to our knitting, the core business, but we're going to do it in a slightly different way. I think as a company we've had too much of an internal focus. When you do produce things like explosives, cyanide, chlorine, all those lovely words the media love to use, you cannot fly below the radar. So we have to have a structure and we have to have an approach where on an ongoing basis we have very strong relationships with our customers, our suppliers and the governments and regulators with whom we deal on a daily basis. We've gone from business unit primacy to strong functional accountability, and I'll come back to that later. But that is a fundamentally different way of looking at how we do business. So we're going to run as Orica, not Orica Mining Services or Orica Chemicals or whatever. We're going to run as Orica. And the outcomes we achieve will be as one group. So we can't leave anyone behind. So it's no good for us if mining services is going well and Minova's going badly. That affects Orica in general. Product innovation. I think we've been spending a fair bit of money on what we see as groundbreaking technology, but we really have to drive the point about, is it what the customers want and are we commercialising at the right rate? So by amalgamating under one person and bringing that person on the executive, R&D will have a clear focus that if we're going to spend money, we need to commercialise it. And if we can't see a fairly quick pathway to commercialisation, then we won't spend the money. And finally, and a fundamental point, control and ownership of major plants. We're going to change to a nuance point where we look for the lowest cost product source. So if it's capitally efficient to manufacture, we'll manufacture. But if it's better to have alliances, we'll have alliances. And we will try and control the supply chain in ways that give people security of supply and multi-channels. Now, that isn't as drastic as what people may think. At the moment, we produce less than half of what we sell when it comes to ammonium nitrate. We deal with over 40 external parties to make up the shortfall of supply of ammonium nitrate. So we've got to leverage those relationships better so that we make decisions based on what gives us the best capital return, not the idea or the paradigm that when you manufacture it gives you a natural advantage. Sometimes it does, sometimes it doesn't. We need to be flexible. So putting that strategy in a different way, we're going to provide differentiated products, services and solutions to our customers across the globe based on reliable, low-cost, multi-source supply chains, capital-efficient JVs, and development and commercialisation of differentiated products. So you'll see a different emphasis of the way we go about spending money and the way that we position ourselves for growth around the world. One other thing about the geography, we are dominant in Australia, Latin America, North America and Indonesia. I think we need to have a specific focus on Africa so we get ourselves to a dominant point in Africa in the shortest possible time frame. Two reasons for that. One is Africa will be a major growth point for us over time. But secondly, and just as importantly, if our major competitor in the world who can destroy our margins, i.e. China, is going to break out of China, it'll be in Africa. And we need to be there in significant positioning points before they build that base. Because I can assure you they have a different appreciation of what is a return on capital than what our investors like to see. So basically our 8 competitors are mainly moving down into this bottom left-hand corner. So they're not going for differentiated products, they're keeping it simple, and they're going for more and more manufacturing as a percentage of their base. We're going to move up into that top right-hand corner. There's risks in this because you have to have the capability to do that. You have to have the flexibility built into your structures to make sure that that customer relationship and that forecasting ability is better than anyone else. We need to be aware of what every major production country in the world is doing, thinking, etc. So we need to build our customer intelligence base to a very large degree, and we have to be a lot more customer focused than what we have been in the past. So let's look at it a different way. Instead of just relying on price and volume to build our margins, there's another 4 ways that you can pursue right throughout the economic cycle and the pricing cycle, the building of margins within the business. The first of which is structure. So by going to a functional and value chain structure as we have, it enables us to be able to grow without duplication and replication that you get through business primacy. As I said before, we're going to be pursuing the amalgamation of mining services and Minova in Europe. We're basically carrying 2 structures in an area that doesn't give us that great a margin on EBIT. You can't afford to be doing that. So that structure will drive that margin growth. It'll enable growth without having to take your overheads with you. On manufacturing excellence, we have a huge amount of low-hanging fruit in manufacturing. None of our big AN plants are running that well. They can all give us more if their uptime is lifted through proper application of maintenance. And not one of the initiating systems plants goes anywhere near to be fully utilising its installed capacity. So the rationalisation of the way we go about that, the concentration on doing maintenance properly, will give us an enormous amount of margin growth. Currently our plants sit up in the 4th or 3rd quartile in costs. We have to get them down into the 1st or 2nd quartile. So costs will give a margin growth, but output, when you get your maintenance right, gives you a second tranche of ability to sell to the world and build your margin. Value in use. In the times that we're seeing now, every major customer group is looking at their cost base. They're coming back wanting to have discussions with us about, can you drop your prices? We have to change that conversation into, well, have you thought about applying our products and techniques differently so you get a better bottom line and we get a better bottom line? In other words, we will leverage our balance sheet and our size to carry some of the risk while we trial with them how we can let them put more tonnes through their process plants, let them recover more coal out of their coal mines. That again is a differentiation point for us, and the more you move in that direction, the higher your margin. And then sourcing and logistics. As I said before, we deal with over 40 groups of supply. Chemicals is moving a lot of materials around, and over time we'll be moving more and more in from China. We need to get on top of how we go about our sourcing and logistics. To that end, we're actually pursuing the purchase of a couple of ships as we speak, and now's the time to look at those purchases because the shipping world has tanked. But for the particular types of ships we use, if we don't reposition now, we'll get hit with higher costs over time. So again, it's that flexibility plus pushing down on your cost base. Now coming back to manufacturing excellence, we've already started at Kooragang Island. What we're seeing is an improvement month on month in our maintenance baseline KPIs. The performance of the site is more stable, apart from recent events where we had a bit of a failure in some valves, etc. But all of the KPIs are suggesting that we're actually getting on top of that maintenance backlog and the stability will come to the site. Now, what we've developed at KI will be applied to all of our IS and AN sites. So that approach will be ongoing and rolled out over the next 2 years. So, in summary, we have lots of opportunity. Urbanisation will continue. China will go back to sitting on around 7.5% growth. The difference this time, when they go back to putting their foot down halfway through next year, is a lot of that growth will be driven out of their domestic consumption, not just exports. Then on top of that, the declining ore grades will mean that there's more and more of our materials used each year, cyanide through the whole chain, to get the same amount of resources out of the ground. And people want to be more efficient and apply more effective technological points. And we're in a position where we can help them do that. So that was the presentation yesterday. The main summary point, take all the clatter out of it, there wasn't much reaction to Minova getting written down. It was interesting, we had reactions from about time to, "You sure it's enough?" But no one pushed back on the logic of it. The main feedback point from people, and something that is going to stick with us unless we change, is that we haven't been generating enough cash. We've been spending lots of money, but we haven't generated enough cash. So S&P to be BBB plus sit for a company like ours in a range of 35 to 45% of gearing. We're sitting just above 41. Now, if we went ahead with KI, at the moment, the expansion of KI, on top of Bontang, and on top of the other things we need to do in improvements, then we would be pushing that up to close to 45% and getting ourselves in a position where we either have to address our balance sheet or we get re-rated. We basically have to get this company in a condition where it can carry a KI or a new plant within its cash flow. So the expectation out of all the capital that's been spent over the last years is that our cash flow should have been about 700 million higher than what it currently is. So that's a 50% increase on the cash we generated last year. We have to go after margin growth, because until we get ourselves in a position where we can fund a lot of our expansions out of our own internal cash flow, we won't be considered as a good investment stock for growth. That's a pretty simple bottom line. We have to improve our margins, but that is not just price and volume. In the part of the curve that we're now entering, if China doesn't significantly put its foot down in the upcoming period, you won't get much price and you won't get much volume improvement. But you will get those ongoing pressures of costs. So if we don't build our internal margin accretion points, we will get to the point where we won't be able to do anything without impacting on our rating and or our gearing or the amount of capital we're able to use. So it's going to be an interesting 12 months because this is the turning point. I hope you enjoy it. Does anyone have any questions? Now, after someone makes a speech like that, you've got to have a question. I just told you that strategically we're changing direction and we're going to really push down on our cost base, and no one has any questions about that. Okay. Are there any questions that come in from the webcast?
No, we haven't got any.
Okay.
Ian, I'll ask the first question. Kick things off. You've talked a lot about the opportunity.
Otherwise the webcast people can...
To help kick things off, Ian, you've talked a lot about the opportunity, and there's no doubt that there's many of them. Can you talk a little bit more about what the biggest challenges are in that strategic change of direction then? Because it is more than a nuance, as has been described. It actually involves quite a shift in the way that we do business. So what are the big challenges for us in achieving that?
I think one of the biggest challenges is actually not relying on the fact that people have to use us, to the point where our customer relationships are such that people want to use us because we have a compelling business proposition. So they want to use us because we're a reliable supplier, they can trust us, we share improvements as they go along, and we continue to ask them what they want and we actually react to it. Now, a lot of people in the room will say, yeah, well, that's what we've been doing. We have, but this is a different degree point. If we're truly going to be flexible in the way that we deal with the markets and truly flexible in the way we deal and talk to customers, we've got to take it to a different level. We've got to do, and I'm borrowing from an example that another person in the organisation uses, we've got to do the transition that Telstra went through from a couple of years ago where they were extremely horrible to deal with to now just being tolerably horrible to deal with. Now that's not suggesting that Orica's like that, but we've all seen that Telstra's actually been repositioning itself in the way it deals and talks to customers, etc. Now they do it in a very public way, but behind the scenes they're actually making it easier to work with Telstra. That is something we have to do with our customers as well. And we have to make sure that they truly understand that if there was to ever be a situation like KI again, we can back them up. Now, we've put a lot of contingency in place in the Hunter Valley. We actually used a little bit of that contingency for the various ups and downs we've been going through over the last couple of months. And that reflected on some of that working capital that we've been carrying. But we are now at a point where if we were to have a very, very similar KI event, the customers would not see it to anywhere near the same extent as they did last time. That's the type of basis we've got to get to. The way that we deal in logistics, the way that we think about, will we turn ourselves into a trading desk for ammonia, ammonium nitrate, cyanide, caustic, all sorts of things. That is a very different capability set. Just the way we go about projects is a different capability set, because we aren't an organisation that are used to doing big projects in different places around the world. So that capability has to be enhanced. So I think there's a lot on training, there's a lot on development, but it comes down to capability. All right, well, instead of me standing here staring at you and you sitting there staring at me, I'll just go back over the summary points. We have been through a fairly transitional year. KI, etc. were a few wake-up calls. Yarwun was an even greater wake-up call for me. I don't know how many of you appreciate what happened at Yarwun, but basically we got 299 charges because some people, i.e. the regulators, got to the point of view that we weren't complying with our own licence conditions. And a reasonable person may have got to the same point. Now, we just resolved that with the regulator, where we got basically 4 charges not recorded, and we agreed to contribute to green turtles and a few other things, and paid a $180 fine, $180,000 fine. Those 299 charges we were on each carried a maximum of $1 million. Just think about that. How does a company get itself into that situation? So fundamentally, we are moving in different directions. Our social integrity will be enhanced. The whole way we go about risk identification and the addressing of hazards will be enhanced. But fundamentally, as an organisation, the opportunities here are huge, and there's no one that can beat us in this industry. We are unique, and it's entirely up to us the degree to which we win. There aren't many companies in the world that can make that statement. I think we've got to fully appreciate how unique we are and harness our talents to make sure that we give people what others can't. Thank you very much for your time, and we'll talk again. Thank you.
If rhythm's a drug, I'm hooked on you. So show me every move. We've got perfect motion. You're pulling me up into the blue. I'm drowning in your love. We've got perfect motion. We want step off the train, I'm walking down your street again, past your door, but you don't live there anymore. It's years since you've been there, and now you've disappeared somewhere like outer space. You found some better place, and I miss you like the deserts miss the rain, and I miss you. Oh, like the deserts miss the rain. Could you be dead? You always were 2 steps ahead of everyone. We'd walk behind while you would run. I look up at your house, I can almost hear you shout down to me where I always used to be, and I miss you like the deserts miss the rain, and I miss you. Oh, like the deserts miss the rain. Back on the train, I ask why did I come again? Can I confess I've been hanging round your address, and years have proved to offer nothing since you moved, and you're long gone, but I can't move on, and I miss you like the deserts miss the rain, and I miss you like the deserts miss the rain. I step off the train, I'm walking down your street again, past your door. I guess you don't live there anymore. It's years since you've been there, and now you've disappeared somewhere like outer space. You found some better place, and I miss you like the deserts miss the rain, and I miss you, yeah, like the deserts miss the rain, and I miss you like the deserts miss the rain, and I miss you. Oh, I'll bring you flowers. Whoa, baby. Oh, yeah, yeah. Hey, from the day until the day we throw it all away. Let's talk about it, 'cause I can do without it. Your love, it means so much to me. Can't you see? Right here I'll always be. Oh, by the way, did I say that I am here to stay? Right here beside you, I will never deny you my love. You're everything to me, can't you see? I will give it you unselfishly, because I need you so. Whoa, baby, and I will never ever let you go. I'll bring you flowers in the pouring rain. Living without you is driving me insane. I'll bring you flowers, I'll make your day. The tears you cry, I'll dry them all away. you want, you're